You've got 100 million Americans living paycheck to paycheck. This is back in 2017. I'm so stressed out about the fact that I don't have money in my bank account. I know a bill is going to come and that's going to set me off into a rough trajectory.
Really excited for this interview with Hamel, the co-founder and CTO of Brigit. This summer, they crossed 100 million in revenue, 1 million paying subscribers, and they've been profitable for over 2 years. And they did this by building one of the top financial apps. If you go in the app store, you'll see that they are above Barclays and Robinhood, although below Geico and Dave, for example. And what's more interesting is in a category that a lot of investors were skeptical of. So in 2017, if you pitched a VC on a consumer PFM that does lending, it sounds like a really good way not to get very many meetings. But as we talked about, they're actually doing quite well today. I think we're in a really interesting era of consumer fintech where there's actually more up for grabs than there ever has been before, but investor sentiment is more negative than it ever has been before. So I want to profile some stories of very interesting companies that are doing well to show you that, yes, you can build great consumer businesses even if there is investor skepticism. So very much excited for this conversation with Hamel, and hopefully you'll take home some good lessons about what it takes to build in consumer fintech. Hamel, so great to have you here. To get viewers oriented, first I just want to talk about what Brigit does.
Yeah. Thank you for having me, first of all. I think it's, as I mentioned to you earlier, full circle kind of coming here. Zubin and I distinctly remember watching a lot of the Cambrian sort of meetup videos from 2018, and we learned a lot from those.
Yeah.
So it's
I think you watched Ram from Earnin at one of our in-person events.
Yeah. There are very few people who I think were putting out useful stuff for early fintech founders back at that time. So very cool to be here.
Yeah, and for folks the content is not well produced, but if you're in the niche and you're looking for these people talking, it's one of the few places you could find it. And if you listened to it, it was good. It was just poor production
it's
quality.
Just what we needed. But to tell you about Brigit, so we think of ourselves as a financial health app for most of America. Our goal is to do two things for our customers: ease their short-term financial stress and get them on the path to better financial wellness. And we do this through a variety of different products that we provide to them, trying to provide more and more solutions for them over time, but started with really trying to help people avoid overdraft fees and deal with sort of short-term cash flow mismatches where, maybe my bills are due today, my paycheck's a few days away. I don't have access to credit because it's pretty hard to break into the credit system here in the US. And so how can we help them avoid that? That was kind of our first instant cash product. And then over time, we've sort of tried to build out a bundle that really looks at their financial lives holistically to help them build credit while building savings, help them save on things that they're already spending on, budget better. So really trying to look at their financial lives as a complete picture and build a bundle for them that's going to work and take them on a journey of graduation. Yeah.
And you start with an initial insight around overdrafts, which is kind of a layer for overdraft protection. And then I think, building a multi-product bundle is interesting. So instant cash you lead with. And then what are the other 2 to 3 things?
Yeah, the other two sort of key products that we focus on for our customers is credit building. So often customers who come in maybe need short-term help dealing with cash flow mismatch. That's where instant cash helps them. But over time, this isn't a permanent state for them, luckily, but that doesn't mean that they're magically in an amazing financial state. It just means they're sort of in one place higher. And so the next problem that they're often struggling with is, well, why was I overdrafting in the first place? My credit score isn't good. You've got over 100 million Americans who are thin file, no file, or damaged credit. And so that means that if they need help with financial products, they don't have access to the ones that they need. And so our credit builder product was the second product that we built out to help them save a little bit every month, but use those savings to help them establish payment history, which helps them build their credit score and hopefully open doors to access to credit and access to financial products that they need later. So credit building is, our credit builder is the second sort of product that we offer. And then the third one is a financial insights product. So really looking at their transactions, layering in not just the sort of traditional PFM tools, but also how can we use the information that we're seeing that's coming in real time, that raw cash flow data, and give you an insight that's going to help you, make a change in your financial life, either adjusting a bill or...
We'll talk some more about the underwriting behind the lending, the cash flow data, which is interesting too.
But so those 3 products are sort of the key products that we focus on, is how can we use that transaction data to serve all the different aspects of your financial life.
And that's the product bundle, and the business model is 95% subscription.
Yeah, it's predominantly a subscription business model, and we started out with that because one of our early advisors, a gentleman named Corey Stone, who used to be at the CFPB, now at the Financial Health Network, kind of espoused the benefits of having a business model that's aligned with your customers' long-term financial incentives, right? And so with the subscription, we're able to look at not just that short-term cash flow mismatch problem, but we have the flexibility to say, okay, if we can solve a different problem for you that's going to put you in a better financial state, it's more worth it for us to do that. And so it gives us the flexibility to look at wherever they are in their journey, which is really cool.
And it creates alignment. Also, it creates clarity for investors. If you have a subscription business model, it's a lot easier to understand that you do offer loans, but those are through partners, so you're not actually taking risk yourself. Cool. So we talked about in the intro, basically 100 million in revenue, million subscribers. You've had a lot more folks interact with your various products. You're profitable now. That's great. I want to back up though to kind of where you got started, because if you like pitched an investor in 2017, like, hey, I'm going to build like a PFM and we're going to do lending, it sounds like a good way to not get a lot of investor meetings. So I want to hear a little bit about the kind of the early days of Brigit, what led you this problem, and then also what it was like to go out and pitch investors and build a team.
Yeah, so before Brigit was even a thing, my background is I started my career in tech, actually at Palantir. And I was very lucky at the time that I was starting my career to get exposed to working with cash flow data. This is before I think anyone in the US was really thinking about cash flow data and consumer lending. So it was a really novel experience. And then fast forward, I
And who was Palantir working with to basically?
So these were retail banks outside of the US was who we were working with. So no one in the US I think was really looking at this. But outside of the US, I think some companies in some countries are a little more flexible with how they think about data. And so it gave us exposure. But I think it also gave us an understanding of how hard it is to actually work with this data, which I can talk about more later. And so fast forward a couple of years, I spent a couple other years at places like Bloomberg and Two Sigma, and then was feeling a bit of a mission gap in what I was working on there.
Working at hedge funds wasn't like really doing it for you?
Yeah, it didn't scratch the itch for me. And so I started, talking to folks who I had worked with in the past, had a really big network from Palantir, and a couple of the folks that I'd worked with started connecting me with startup-oriented people, and that's where I got connected with my co-founder, Zubin, who had spent over a decade at Deutsche Bank. And he had seen the benefit of cash flow data and what it could be used for in the sort of commercial and high net worth individual banking sense. But we started looking at it here in the US and realized that...
And his version of the story too is it took him 5 minutes to like convince you that this was a problem. I don't know if you have a different version.
No, that is 100% true, because I think once we started talking about this problem, the numbers were just so stark. You've got 100 million Americans living paycheck to paycheck. This was back in 2017. And here was an opportunity where they're living paycheck to paycheck. They're spending crazy amounts of money overdrafting. That was really the sort of key insight that I think he had pulled out digging into financial health in the US at that time. Was you've got tons and tons of people overdrafting, living paycheck to paycheck, and they're overdrafting not because they're irresponsible or they're living outside their means. They're just subjected to this challenge where people get paid twice a month on a day of the week, and your bills are due on a given day of the month. And those things don't always line up every single pay cycle. And so you end up, if your credit score isn't good, you don't have a credit card you can charge that to, which again, most of America. And so they overdraft their bank accounts. And they end up spending $500, $1,000 in fees, really crazy amounts.
Zubin talks about he was a first generation immigrant, undergrad, on a full ride. But as a student, spent $1,000 1 year on overdrafts.
And there are folks in my family who are no stranger to overdrafting either. I think that financial stress is not something that's uncommon. I think that was one of the things that caused me to sort of jump in and start working with him so quickly, was because once we started looking at the numbers, and I realized 100 million Americans were suffering from this. And it's a problem that I had sort of known but didn't realize how widespread it was. It really made it a no-brainer to say, hey, cash flow data can solve this problem. And there's an opportunity to build a profitable, sustainable business, but also one that helps people. How often are you going to come across that opportunity? And so to his credit, he's 100% right. As soon as he started talking to me about it, I was like, let's go do this. And so I left my job pretty much immediately, actually pulled over one of the engineers that I worked really closely with back when I was at Palantir. And we kind of hit the ground running on day one with no product. There were 4 of us sort of founding at the beginning. And we just got out and started building in
this
parallel.
This is all in 2017.
This is late 2017.
In New York.
And in parallel, we were like, well, I guess we need to raise some money to launch this product. So let's start talking to investors. And so took a few trips out to California. And the reception was not
Before,
the
so
strongest.
just set the stage. So it's 2017, right? Plaid's been around for a while. Other people have been building in the space. You've got a New York investment banker with this idea. Zubin, you have you. Working for Palantir based on the West Coast, but you're actually in New York, both where cash flow data come together. And then, you've got this idea, you're fired up about it.
We have this idea that we think is really great. We've got a very strong team when you look at sort of where everybody has worked. And so we thought this was going to be a no-brainer, especially when you start looking at those market numbers of 100 million Americans living paycheck to paycheck, close to 100 million Americans who are thin file, no file, or damaged credit. It just seemed obvious. And the more that we talked to people, I think consumer fintech at that time, especially lending, but consumer fintech, there was a lot of apprehension around, I think people likened us to, how are you going to acquire customers in consumer fintech? It costs Betterment $300 to acquire a customer. And we were trying to explain, well, this isn't Betterment. It's a different customer who's already paying, in their cases, $500 a year.
And I do want to talk about CAC and LTV and all that later, but
so it's a different customer. But we started talking to investors, and the reception was, it took a while to convince people. We took probably 70, 80 investor meetings that first 6 months, and I think we're lucky to end with a couple of term sheets that ultimately was the lifeblood of the business once we got started.
Yeah. But how big was the first round?
We raised about $2.5 million in our first round, and that closed in January of 2018.
Yep.
And so it was with that, DCM led our seed round, and they've been phenomenal partners since. It was with that we were able to put our heads down and actually start building the product. We actually didn't really have a product when we were going out to raise, because I think it was really important that we were able to convince people that this was a problem. But we kind of put our heads down after we raised that money and went off and built a product, launched, I would say, in sort of early beta in mid-2018. And immediately, I think just the sort of customer feedback and adoption surpassed our expectations, really primarily because this is just such a big pain point. 100 million Americans at that time was a third of all of America.
I think today, if you're building a consumer product, you can still probably start with like an initial product or a wedge product, but you also have the opportunity to build a multi-product solution from day one. But 2017, you kind of have to start with a wedge.
You have to start with the wedge.
What was the first thing you started with?
We started with that overdraft product because it's not the thing that we would have chosen to build out of our preference or what was easiest. But when we talk to customers, every single customer, the pain point was, I'm paying these crazy overdraft fees, or, I'm so stressed out about the fact that I don't have money in my bank account. I know a bill is going to come and that's going to set me off into a rough trajectory. And so you couldn't talk to someone about budgeting. You couldn't talk to someone about even credit building, which is a very salient pain point for them when their bank account is at $0 or close to $0 and they know they've got a bunch of bills coming. And so you have to give them that breathing room. And so that's why we started with that. And it proved out to work quite well, but it was hard. I mean, early 2017, 2018, I feel like that was still pretty early days for consumer fintech especially. It took a lot of convincing for us to even just be able to run our first payment. I think there's a lot of compliance hurdles.
Of App Store approval?
Not just App Store approval, but just getting a bank partner that's going to run payment. I think people take that for granted today. You've got 1 million BaaS providers.
Yeah, we're all stressed about consent orders, regulatory, regulators clamping down.
But there are
products. Not that long ago. You couldn't find anyone because no one had done any of these partnerships.
And so at least there are proof points now that you can sort of point to. But there, we were lucky to get up and running initially actually with SVB. But it took a lot of convincing and, getting a lot of ducks in a row just to be able to send that first sort of payment to a customer, which is the lifeblood of like, if you're going to help people avoid overdraft, you've got to be able to send them money and you've got to be able to collect that money. And rightfully so, I think in this customer base, a lot of partners were apprehensive about letting anyone sort of do this type of thing because the businesses that we're fighting against, whether it be overdrafts or payday lenders, I think have really sort of rough reputations. The downside is if you're really tight on the compliance there, it took us 6 months or so to get our first payment out. Not from an engineering perspective. It was just getting sort of through the compliance
partnerships live. And that's why I'm still excited about consumer fintech. I think you guys have a lot of room to run. You've got 1 million subscribers. You've got 100 million plus potential users. But for people who want to build new products and new bundles, you can go live faster.
Those opportunities are available. And I think, if those were there when we started, I think we would have gotten a lot further, a lot faster. Just even things like card payments were still, for fintech, we're still pretty nascent. Push to card is now a standard sort of feature in every single payment product that exists today.
There's 2 or 3 like APIs for cash flow, underwriting, or analytics or scoring. Plus, Plaid now has a product, and none of that existed.
Yeah. So it's just
then.
so much more sophisticated now, which I think makes it a really cool time to be in consumer fintech.
Yeah, totally. But back to Brigit in terms of, so you start with that initial thing. Talk about the initial product. You're basically building on top of Plaid. Mostly,
Yeah.
right?
So
And
we started,
Plaid
Plaid is really the thing that opened the door for us. And I think we always frame that as the why now of the company, right? Every, I think, good product has to have something that makes it possible at that point in time, why no one started before. And I think Plaid had really hit its stride with respect to coverage, with respect to sort of quality of service, and they've continued to improve on it to their credit over the last 5 or so years. But that allowed us to reliably say, we can get a customer in the door, we can connect to their bank account, we can start looking at it. And there wasn't much on top of that, but we were fine. Once you gave us the data, my background is at Palantir, early folks on our team were from Palantir, like that was our bread and butter. We could work with data. And so, immediately started building our own sort of cash flow scoring platform, our own sort of essentially like payments servicing platform, and also like all of those sort of personal financial management tools, a lot of sort of predictive algorithms to figure out like when are our customers going to need money, when should we let them know that their balance is running low to help keep them appraised of their finances. And so that first product was really focused on, we know that the overdrafting is a big pain point. Can we predict when you're likely to overdraft, either send you a notification or proactively just send you funds if you've opted into it, so you don't even have to think about it. Turn that really stressful moment into something where it's just like, Brigit's got my back, I don't have to think about it. And if we could do that reliably for tons of customers over time, we knew that would build a really strong financial brand where we could start to then think about some of their other sort of financial challenges. And it took a while to do that well, and it took a while to do that at scale. But once we did, then we were able to start thinking about what other parts.
I think in consumer fintech, the product insight often is not the secret sauce. Like the idea that you have cash flow issues and that you could like maybe layer on new products on top of another. Like there are other people who are still doing that today, but the product execution is really hard. It's gotten easier, but it's still pretty hard, and I'm sure you're still optimizing.
I mean, I think you can look at the space that we exist in, and there are many players who are all trying to do the same thing, but everybody's sort of margin and business profile looks very different because, especially in the customer base that we work in, it's a really hard to support customer base. That's why a lot of banks just don't support them, or why a lot of banks charge these crazy, crazy fees. And so for us to
because that's the only way they can monetize.
That's the only way that they can monetize. And so as a result, because they just don't have the tools or the skill set to parse through that data and do a good job of sort of understanding risk. And so the better that you can do at that, the more you're able to provide that value back to consumers in the form of savings, right? And that's why our offerings, when you compare it to the frequent overdrafter use case, which is what we started with, where someone's spending $800 a year, Brigit at $10 a month or less is a huge savings. On your first overdraft, it's already 3 times cheaper that month.
Let's talk about the go-to-market and customer acquisition. What did that look like today? And this is where we're going to start to talk about everyone's favorite word in consumer fintech, which is CAC and LTV. So what did CAC look like originally? What were those channels for acquisition? And you started from day one with a subscription, but help us understand like what the subscription evolved.
Yeah, the subscription has looked predominantly the same since we started. So when we first started, we kind of knew roughly what customers were already paying today because they were overdrafting a lot. We wanted to make sure that we were orders of magnitudes cheaper for them. And we also chose the subscription model because we wanted to have, as I mentioned before, the flexibility to solve other problems for them and ideally graduate them out of this instant cash product, right? We want to help you deal with the short-term mismatches, but we don't want you to be in that situation every single month. So the subscription was sort of the right way to go about it from our perspective. And so when we first started, we knew paid acquisition was going to be the primary driver here. If you're lucky, you can get a viral product.
Another thing investors don't like is hearing the word paid acquisition.
And we were very upfront about that in our early pitch decks. I remember we had done some sort of back of the envelope math, some initial testing before we even had a product, and we ran some paid ads to sort of test it out, and we were getting CACs that were going to be upwards of $100+. And I remember going to investors and them being like, your CACs are going to be higher than that, because they were all sort of pattern matching to Betterment. But we sort of hit the ground running and started.
It's funny they're pattern matching to Betterment. I guess you being in New York and Betterment being in New York, that was something, but there are other companies that...
Yeah, I think, again, this side of consumer fintech was just not as well touched yet. I think now it seems like an obvious, like, oh yeah, you're going to solve problems for most of America. Like, there's a lot of Americans to solve problems for. CACs might be in a different world, but I think they were all mapping to the only fintech products that had been built had been for Henry's, essentially.
SoFi, Betterment, a couple
exactly.
others.
And so that's where, so we started basically running paid ads to acquire customers on the channels you'd expect. You know, Facebook, Google. I think there was maybe a little bit of Snapchat early on, but really sort of grew most of our acquisition through Facebook ads and Google. There wasn't a ton of rocket science there. It was just a lot of iterating and optimizing on, you know, did customers understand our product? How can we sort of message this to them better? And then as we started to hit our stride there, you know, opening up more channels, layering in affiliate, layering in, you know, the other social channels. TikTok became a thing in the time that we started the company. And so obviously that's sort of grown into something, but it was just a lot of test, optimize, learn, test more, run lots of creative, and more recently starting to get into things like TV and other sort of more traditional. As your budgets get bigger, you've got to spread it out even more. Yeah,
and not to like be an apologist for investors, but I do think this is one thing that's hard is they hear, oh, you know, it's going to be paid. We're on an experimental framework. And you're like, oh, I don't know. Like, I haven't seen that work out. So how do I know if I don't have pattern matching? So you have to do the work to prove it out.
Yeah. And so I think we were really comfortable in our early days, even if the CACs are crazy, if you can prove out good LTVs, you can come up with a sane LTV to CAC ratio. And at $100 plus CAC, you know, that's harder to do than at a, you know, substantially lower CAC that we're at today. Frankly, we came out of the gate and our CACs were, you know, close to an order of magnitude less than that. But we sort of were diligent about making sure that at least we knew we were going to be able to monetize this product enough to compensate for a high CAC. And when CACs ultimately came in lower, it was just a great situation to be in because then we could just scale up our budgets even more, right? So as a subscription business company, we've from day one always been rigorously focused on sane LTV to CACs, right? Whether it was in 2021 when the market was exploding and everybody was pouring their budgets into marketing, or whether it's today, we've always tried to hold a really high bar for just a good LTV to CAC. And if you need to slow down your growth to make sure that you're managing to that, you're managing to a sane profitability, you'll grow a little bit slower, but you'll have a solid business under you.
And I think for having the like LTV to CAC and the paid acquisition, you know, again, not something investors love to hear, but if you execute against it well, it can work. I'd like to hear you react to this because this is something I think about a lot. I interviewed Renaud, who's the founder and CEO of first Lending Club, then Upgrade. And it's like, what's your number one bit of advice for fintech founders? And he says, have an experimental framework for how you do your go-to-market, which is particularly true for consumer because you have to have an experimental framework to figure out what works and doesn't work.
100%. And I think it's basically we've run our business on experiments from every sort of stage of the funnel, whether it be sort of creative testing at the very top end with, you know, what creative are we running? How is that resonating with our consumers? Within this channel, you know, Facebook is going to look different from the ads that you're running on Google is going to look different than certainly the ads that you're running on TikTok and certainly what you're putting on TV. Those are all sort of different. So we've got to have different frameworks to test. You're essentially A/B testing copy and images and video, and then pick the things that win, run with them, and then iterate and learn off of those learnings and try and also keep a better systematic, I think, especially early on, a very systematic understanding of why did this one perform better than the other, change one thing at a time. And it's through that if you do that really quickly, you can kind of hyper optimize to the best performance that you can get. But then do it at the next level of your funnel too. You know, your landing page, your app store page, do it on the first page of your app, do it on the activation screen of your subscription. And so, you know, you've got to test and learn your way into good performance. And that's, I think, a big part of how we've been able to continue to sort of improve our funnel performance over the last, 3-4 years, despite our customer base growing and despite sort of pouring more people into that funnel.
It is kind of frustrating, I think, if you want to start a company in consumer fintech because you hear these things like, just give me the answer, give me the silver bullet. And it's like, sorry, man. It's a lot of lead bullets.
It's just a relentless execution every single day. And I think that's one of the other things that we've done.
And then I think we're 7 years later for you guys, you know, you're going to have $100 million in revenue. And
It's not a fast journey by any means, but I think we've also, the theme that you'll probably see, whether it's focusing on LTV to CACs, whether the market is good or whether the market is bad, or even today, we've always focused on let's drive small incremental improvements. And that's where I think a good testing framework does really well is if you drive, a 0.5% improvement every single week, your business looks dramatically different at the end of the year. And so we place a lot of emphasis, whether it's in our customer acquisition strategy or in our product, on choosing things that are going to make the product incrementally better for our customers every single week. There's always something going out that makes it better for someone. And through that, you can see the metrics improve reliably rather than, we certainly take big bets, but we try and counteract that with a lot of really reliable small wins.
Yeah, I also want to reflect on, as we talked about, getting the first check in the door for your first round was hard, talked to 80 investors. Subsequently, though, you went on to raise, I think, over $100 million in total. Is that right?
That's a combination of equity and debt. Equity, we've raised about $40 million. We raised a Series A in 2019, which was led by Lightspeed. But since then, we haven't done any major equity rounds, really. The primary funding of the business, and that $100 million number comes from, we have a credit facility to fund the instant cash product. So that's another thing, that if you go and start a business that engages in giving people money and expecting to get it back, you're going to need to figure out how to finance that sort of separately from the equity that you use to run your business. And so in 2020, 2021 is kind of when we closed that facility, which is the lifeblood of what allows us to, be able to send funds to customers. And so that's sort of separate from the equity that we raised in 2019.
Knowing what you know now, is there anything you would have done differently around your fundraising strategy? You're not, 2021 was kind of a crazy time where some people went out and raised hundreds of millions of dollars of equity capital and then got out of their skis from a valuation, from a cash burn. I don't know if Brigit felt any of that, but I'm curious, even for you and your...
We absolutely felt it. I think a lot of credit goes to my co-founders even in just being prudent around 2021 came around. Towards the end of the year, we were thinking about going out to raise, but we said, you know what, we want to make sure that our metrics are in like a really solid place before we go out and do that. We know we're going to spend it if we go out and raise. So let's focus on continuing to solidify sort of the bottom line of our business, continue to solidify our unit economics, and we'll go out and raise when we feel really comfortable with those and then spend into that. The market obviously turned in between making that decision. So in some ways we didn't time the market super well, but when that market turned, we found ourselves in a really good position because, I would say between Q1 of 2022, Q2, I think is when everybody really started to panic. We made the decision to really focus on profitability in July or so. And by November, we were bottom line profitable.
So a few months, July 2022 to November.
And there, thankfully, we didn't have to make any dramatic changes to the business because we had always been prioritizing sane LTV to CACs and sort of solid unit economics. I think we just said we're going to shift our focus from investing into cleaning up things that we had sort of put off. Let's make sure that we manage our payments costs appropriately. Let's look at our contracts. Let's tune some of the usage of these APIs that we're using. You do 20 of those things over a 2 or 3 month period, you can drive a lot of sort of improvement in the bottom line. And that was really the only switch that we needed to flip in 2022. So I think in some ways we regret not going out to raise and raising a lot of money, but in other ways, I think it forced us to be really thoughtful about how to run a good business. And we didn't hire into that because we didn't go out and raise. So as a result, we've kept a really lean team, which is honestly great. I work with, we've retained a strong team and they're people that I learn a lot from working with. And so kind of choosing to hold a little bit for that period, I think has proved to be pretty prudent.
Yeah. And let's talk about COVID as well. When you're building a consumer company, especially consumer financial company, you are subject to shocks. That could be a 10-year recession like the Great Recession, or it could be the deepest and shortest recession we've ever had, which is the COVID-19 pandemic. So what did that look like when the government airdropped $2 trillion of stimulus, especially for these cash-constrained customers and for your business?
Well, let's talk about actually what it looked like before they did that, because I think 2020, when COVID came around, we're in a business where we're helping people deal with short-term cash flow mismatches, but they're folks who are employed, who are living within their means, but on their financial lines. And all of a sudden you get told, well, food service is just going to shut down. Retail is probably also going to shut down. Everything's going to shut down. People are going to lose their jobs. I think for us, we had to think really critically about, okay, how are we going to manage essentially our book of advances to our customers in a situation where maybe a lot of them lose their jobs. And so this is, I think, where the power of cash flow really shines. And I think one of the things that has allowed us to succeed through that period was we could look at our customer base and say, all right, well, these folks are probably employed in jobs that are going to be able to weather through it. We can kind of go through our customer base with a really sort of close eye and find just the pockets where we need to manage risk in a way that I think you couldn't do with a FICO score. You couldn't even do just if you knew their income. We could see, did they get their last paycheck? And so we were able to make a lot of decisions to figure out how do we manage risk in the event that all of these folks lose their jobs, which is a really hard sort of thing to tease through. And then thankfully, as you said, government solves that problem for us, starts airdropping tons of money to people. And frankly, it's far more than I think our customers have really ever seen in their bank accounts for a long time. So their savings just go through the roof. But also we saw their spending change. I think this is broadly known, but I think spending also largely upticked in our customer base. But they could do that sort of comfortably. We saw a lot of also people using that responsibly to pay down debt that they had incurred.
You see this credit card debt went down, starting to go back up, but it's still on a GDP adjusted basis, pretty reasonable.
And so that was actually our first foray into profitability. Was we sort of batted down the hatches, thinking that things were going to really go awry, and then thankfully the government sort of essentially bailed out the entire economy there. And so as a result,
Sequoia had the black swan memo. They're like, it's all over for venture, and then venture's like, no,
it goes in the opposite direction. And so our customers, were in a dramatically better financial state. And what that meant is our losses, completely dropped to a place that wasn't even seen before by us. But the other thing was there was less demand for our product, which frankly, broadly for the world, I think is a good thing, knowing that people are not frequently overdrafting, knowing that they're not stressed about their next paycheck. And so we saw, customer growth slow for a little bit during that period. It was buoyed by profitability, so we were willing to sort of accept that trade-off. And we used that to start to invest in these other products like our credit building product because, well, if our customers are in a better financial state where they're not overdrafting constantly, that doesn't mean that they're magically, making six figures in an amazing place. It means that they're just a little bit less stressed. How can we turn this into an opportunity for them to set themselves up better for the future? And so savings and credit building felt like a really natural way to take this money that they had saved up and use it to set themselves up for a better long-term outcome. And so that was kind of the genesis of our credit building product was at that time.
Another curveball you can get building anything in fintech, but including consumer companies, is if infrastructure providers go out for you. So after the COVID pandemic, SVB gets shut down or falls apart because interest rates go up, and that's a whole other conversation. But they were your first payment provider. I'm curious if there are any big
so thankfully
issues
there weren't any major issues. So SVB was one of our first payment providers, and we were very lucky to be able to work with them at the beginning. But as you grow, it's really important to build redundancy for this example.
Build redundancy, that is a good big lesson for people listening as soon as you can.
That I think even we took a little while to learn, but thankfully we already had multiple sort of banks sitting under us, not necessarily for payments, but we had moved off of SVB because I think they also weren't really geared towards this type of consumer fintech business. And so we had diversified a little bit in a way that made that manageable for us. Thankfully, I think more sort of luckily than intentionally in that situation. Today, though, I think we've been a lot more focused on building out redundancy, as you've seen with all the vast sort of challenges that have happened over the past 2 years. I think it's a thing that we're continuously investing in. There's every single part of your stack you can find redundancy for. And so that's a thing we're working on.
And what should we think about for Brigit in the future? Like, so obviously you're going to keep testing channels, running experiments there. Are there new products you're very excited about, new customer segments, other things that are just different?
So to set the stage, I mean, we started this company looking at 100 million Americans living paycheck to paycheck. Today, 7 years almost later, there's 175 million Americans living paycheck to paycheck. There's something like 50% or so of folks who make more than six figures are living paycheck to paycheck. I recently learned that more than 30% of people making 200,000 or more are living paycheck to paycheck. So the financial stress problem is one that's getting bigger. And so I think with the products that we have today, we're going to continue to invest in those. We've barely sort of scratched the surface. 1 million paying customers is great, but it's less than 1% of that problem. So we're going to continue to really invest in the stuff that we have today. I think one of the things that we've done really well is focus. And especially, I think that's something that we've learned the hard way. Diverting your focus comes at a cost. And so we're going to continue to focus on the core business. But I think we've also learned that there are benefits in sort of having multiple products. There are synergies of having those two things together, especially in a subscription business. And so I think we're going to continue looking at, and we've got some ideas that we're starting to test with our customers. Nothing we can share just yet, but of how we can look at other points in their financial journey that we're not yet touching. Today we're focused on the day-to-day problems and maybe the next 6 months. Are there problems that span even longer periods of time that we can work with them on? Or, other sort of financial situations that may come up that we're not yet touching. And so our goal is to take the subscription bundle that we have and continue to layer more value into it. And so over the next, I think, 2 years, we'll probably shoot to get a product or two out that continues to add to that.
Yeah. And another key part of building any business is thinking about exit. And there are a bunch of different forms that can take. And I think in consumer fintech, that's an interesting question. So I'm sure it's where you are in that journey. And to set the context too, if you look at consumer fintech in the public markets, first it went up in the right harder than anything else. Then it crashed harder than anything else. Now it's actually better. And I don't think the sentiment has caught up to that. But how do you guys think about IPOs, strategic M&A, just being a standalone profitable business, maybe private equity? Like, what are you guys thinking about?
Yeah. We've, I think, always focused on let's run the business so that we have the flexibility to choose. And that's why profitability has been sort of the primary call for us within our team is let's focus on making sure that we're profitable, making sure that we've got a sustainable business so that we can evaluate options really concertedly. There's never a gun to our head to make a decision. As founders, and especially at this scale of the business, I think the only thing that you can really plan for is to plan for IPO. That's something that we have in our control. And so for us, it's continuing to march towards that. Building out more products is one way to continue to grow our revenue with our existing customers and therefore sort of get us closer to that, continuing to acquire more customers. I think ultimately the benchmark in the public markets has sort of been raised with respect to how much revenue you need to get there.
Certainly the narrative around what the benchmark is, and this is, people will say, oh, you need $700 million to go public. I think that's not really true. If you have good cohorts, good growth, you can be lower than that. But growth is key and demonstrating it.
Yeah, and I think where we are, we're well above 100 million in revenue today, but I don't think we're there quite yet. I don't think it's 700 million to be fair, but I also don't think 100 million
I think it does, 100 million probably not. You can start to get 300.
And so I think that the benchmark that we're looking at is something probably just above that to really set ourselves up for that. And so there's a lot of stuff we have to do, not just grow that revenue, but operationally growing a company to be ready to be public. We're a lean team of 100 people today. There's things we can do because we are private that I think we'll have to start just building out our operations a bit more to support on the path towards becoming a public company. And so that's the thing that's in our control, and that's what we're really focused on. But ultimately, all of that is in service of a mission, which is get our products into the hands of more people who need it, solve more of their problems, and take sort of a deeper share of their financial life that we can help them with. And so growing our business as a standalone entity is the thing that we have control over. I think there are financial services is a story of strategic sort of bundling. And so if there is an opportunity that makes a lot of sense that carries us on that mission, I think that that's something that we would certainly consider. But what we have in our control because of the profitability is the ability to just focus on taking this to the next level as an IPO.
And I hope you guys go public for not just because that probably means you're doing well and are excited about the business, but also because you're talking about how frustrating it can be to pitch investors about a business. And investors, if something hasn't worked before, they don't know how to know whether it will work. I think we need more examples of companies, what does work, what doesn't work, and having the transparency of the public markets can really help the whole ecosystem as a result. Because what you guys are doing doesn't map particularly well to, maybe to some extent, Dave, but there isn't a lot of, comps out there. And then it's just very thin for investors to think through. Well, I want to kind of recap the lessons for entrepreneurs who are thinking about building something. So I think one, which is kind of the frustrating reality of consumer fintech is there's a lot of lead bullets. It's just execution. It's a big thing. Two is, and this is kind of a narrow point, but you can't forget it, is redundancy. Three is start with a wedge, grow into a multi-product solution over time. Although I would say I think you can actually start with a multi-product solution if you figure out how to tie those things together correctly. And then this was the one other one was don't get too far out over your skis from a cash burn perspective, right? Like you guys, I think, were within spitting distance for a while of profitability.
Yeah. I think those are all spot on. If I was to order them though, I would say I actually do feel strongly that starting with a wedge is the right way to go about it, because you can launch a multi-product solution, but the truth is
one thing is going to drive it, right?
One thing is going to drive it, and with our focus on driving incremental improvements, getting that first product out the door as quickly as possible was hugely valuable to us learning. And so if you can find a way to sequence things, that's how we always do it as a business. And that also translates really well to then being able to, if you focus on incrementality, you can make moves towards profitability really easily. And so I think those are the two most important that we think about as a business, but agree on all the other fronts as well.
Yeah, totally. People like to learn from things gone terribly wrong. They can also make for interesting stories. So any like particular kind of hard moments for you building the business?
Yeah, I mean, I think you
hopefully it's all going great now.
It is. I would say it is going great. I think you hit on it with COVID. Was probably one of the scariest times that we could have gone through. And I think I'll reiterate credit to my co-founder on this one. As we got through that, the thing that really helped us go through it was always just being really solidly focused on unit economics. And I think it's easy to say in this market, but when we started the company, even in 2017, 2018, there was a lot of skepticism towards our business model. But once we got over that hump, then the conversation was back towards growth.
Yeah.
And certainly through 2020, 2021, once the market was booming, that was the only conversation. But Zubin really kept a strong head on his shoulders around, we've got to have sane unit economics. And that, I think, if you do that, you've got a solid business. It doesn't matter what's going on in the macroeconomic environment. Yep. Maybe you'll tune things, your growth will slow down, but you'll always have profitability, which means you'll always have the fate of your company in your hands. And I think that that's something that has just been a huge lesson for me personally, as someone who came purely from, I would say, the tech side before this almost. Being able to just focus on that and have that in your control just sets you up to be in such a better position than anywhere else. And I don't think there's no market cycle that you'll be through where maybe people value profitability less, but in that market cycle, you can just wait it out until the next one where people value it more.
Yeah, totally. I have some fun questions too, just rapid fire to wrap things up. So first one, SF versus New York City, especially for building in fintech. You can dodge it. Don't dodge it.
I won't. I'm a diehard New York person, so it's really hard to. I think, especially in the past 4 or 5 years, New York has really, I think, started to have a much more vibrant sort of tech scene. And so, I think today, especially for fintech, it's really strong. I don't know if there's a clear winner there, but when we started the company, New York really wasn't an option. We had to fly out to talk to all the investors. Today, most investors have offices in New York. So I think that New York is the greatest city in the world, and I will say that hands down. But for consumer fintech especially, I think you can do it in both places, which is far better than it was 5 years ago.
I love San Francisco, but begrudgingly I acknowledge that New York is also a great place to build companies, especially in fintech. But you guys do have an engineering hub out here, I think.
We do,
which is good to know. And then 2 was, I guess, somewhere on the topic of geography, in-person versus remote.
We opened the door to remote when everybody else did in COVID, and I think that was the right thing to do to bring on some really quality talent. That being said, I think it is very beneficial in early stage companies to have time together to make really quick decisions. I think decisions are the thing. I think Jeff Bezos says this, right? That builds sort of momentum in a company. And being able to make those really quickly by just saying something quickly to someone makes a world of difference. So if I was to ever start something again, thankfully, I don't think I am thinking about that for a long time, but I think I would probably go in person.
Yeah.
And we have a strong sort of in-person presence in New York, which has been really, frankly, energizing for me in the past couple of years. That's really picked up as we've started to hire more people come in, and it makes your job so much more enjoyable too.
And then the last one we want to talk about, AI, specifically the new LLM architectures, overhyped, underhyped, just generally useful, specifically within the context of Brigit.
Yeah, I think I'm probably in camp generally overhyped. Once we get to financial services, I think really it's something that we look at very concertedly and want to take our time with.
Yeah.
We've started to test it out in certain places, like especially with our customer support team. But going from testing to actually really using that in a meaningful way, there are so many more things you have to be careful of in financial services. Financial services, generally speaking, is a place where understanding why decisions are made is so much more important, and explainability is so much more important that I think it's going to be, frankly, a really long time before we see meaningful adoption. I mean, if you think about the more sophisticated techniques that have existed for the past 10 years, whether these be like random forest modeling, right? Or even TensorFlow or things that are your early AI, you're barely seeing that adopted in consumer financial services. And so I think for us to get all the way to LLMs in any sort of meaningful way, it's going to take a while because folks are just rightfully so, I think, concerned about what this means for compliance, for example. So I'm on team, take your time and make sure you get it right for the sake of the customer.
I think there's actually a lot of alignment between the two camps. People are like super gung-ho and people are a little skeptical because it's really also a timeline question. It's like, look, this could change thing in 8 years, which actually that's the timeline that most people building companies care about, investors care about. But like, will it change things in the next year or two? It's going to take a little bit of time.
I think financial services is probably one of the later players you'll see it in.
Yeah, totally. Awesome. Well, thanks so much for coming on. This has been super fun. And hopefully next time we have you come on, we can walk through the S1 or something like that for you guys.
That would be a great time. Yeah.
Awesome.
Wonderful. All right. Pleasure.
Cool. So that's a wrap. That's our interview with Hamel, the co-founder and CTO of Brigit. If you like this episode, you should check out our channel. Consider liking, subscribing. We have a lot of other interviews with founders, builders, investors who are helping shape the future of financial services.